Hi, I'm Mark Honeybone from Property Ventures, and welcome to our weekly podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. This is a free service from Property Ventures so that you can keep current and learn from some of the best around New Zealand. To check us out, take a look at propertyventures.co.nz. We hope you enjoyed today's podcast. Hi, and welcome back to our podcast series. This week we have Chris Peterson from Chris Peterson Mortgages, and he's going to talk to us about the new LVR rules, where the bank's thoughts are at the moment, and the Auckland market, and how you can help yourself when you're looking for a loan from the banks. So sit back and listen to a few tips from Chris Peterson. So Chris, welcome along to the show.
Thank you, Mark.
So listeners know who is talking to them today. Tell us a bit about yourself and a bit about Chris Peterson Mortgages.
I suppose Chris Peterson Mortgages, or I suppose starting with myself, I got dragged to a property seminar when I was about the age of 20. It wasn't a property seminar, it was a business/property seminar by a very good friend of mine, and being a numbers person, it immediately got me interested, I suppose, in growing wealth without having to hopefully live on the corporate ladder. And so, especially having seen both my dad and stepdad, do that and get bored of life and having to work for other people, etc., probably having more options appealed to me. I was the type of kid who tended to get kicked out of class, and so probably having, and probably was naturally, I'm not the world's best employee. I tend to try and do my own thing. So having freedom, and that's not just financial freedom, but freedom to do what I want, appealed to me probably from a young age. And also probably looking at the way that property has naturally kind of grown wealth appealed, and I probably like assets which I can touch and feel rather than, and that's why I like property rather than other financial instruments, which obviously other people can tend to manipulate more behind the scenes. And so I got into that from an early age, made a whole lot of mistakes along the way, but I probably fell back. I'm naturally reasonably good with numbers. I'm a lot better at that than probably with, say, a hammer or something like that. So I at the same time, while I was getting into a finance career, I was learning more about property, did a few holds and trades early on, made a few mistakes, but learned a lot of lessons. And I changed from more a role in the consumer finance industry to a role in non-bank lending, which is where I learned to do all the types of deals which the banks won't do. And I did that more to further my own development in regards to my ability to do property deals. After doing that for a while and being asked to do deals for friends and other investors, I created a company called Property Financial Solutions, which is the I suppose starting part of Chris Peterson Mortgages, and that was primarily to deal with property investors and traders. After a few years of running that, we rebranded it to Chris Peterson Mortgages. It's now about the fifth biggest mortgage broking business around in the country. We specialise, I suppose, primarily in the property investment market, but I've also got people who specialise in, say, the first home buyer market, development finance, risk insurance, that type of thing there, to make sure that we can provide a full spectrum of advice for the people we're dealing with.
Great stuff. Yeah, that's I like that. I wish my parents taught me early on to go out there and have a go by myself, sort of thing, and stop working for other people. But that's all good anyway. Hey, just your clients, just so people that are listening, if they're a brand new investor or someone that's really experienced, where do most of your clients come from? Are they, do you have a lot of properties or no properties?
Probably when I first started, and I still sit there and I say this to a lot of people, that you learn more through a recession than you do in the good times, especially with doing the game that I do with finance, that in the good times it's quite easy to get money, but as the market tightens, that can definitely get a lot harder. So the broking business was set up in mid-2007, which was obviously towards the peak of the last cycle, and there was definitely a couple of months I probably got a bit of a big head and thought I was a bit of a rock star, because there was lots of money flying around, and to be honest, you probably didn't even need a pulse to get money there for a while.
I thought early on when you said about your non-lending background in 2007 or 2006 to 8 was just crazy. You could get money from anywhere you wanted. Just newly self-employed at the time myself, and money was accessible so easy.
And it literally, I think the non-bank market in particular was very exciting back then. We were doing all kind of crazy things, but that very quickly changed late 2007, probably going into 2008. And so probably in that later part of last cycle, probably most of my clients tended to be the mid to larger investors who had grown portfolios very quickly on the back of low doc loans. There used to be, for those of you who don't know what low doc loans are, products which you didn't really have to provide income proof. So a lot of investors would run around and mainly target equity deals where, as long as they could either buy or create equity very quickly, they didn't have to provide the serviceability proof that most people have to provide now. And so it was a lot easier in some ways to build large portfolios back then. So probably for a long while it was the larger clients I was dealing with, and we still deal with a lot of large clients. I've got a number of clients who would have 100 plus properties on the books, but we literally deal with everyone who's looking to buy their first property to those large investors. I've had a number of meetings already this week where we tend to sit down with people who might own just their own home and are still looking to put their toe in the water and just go, as property investment for us, how do we do this properly, through to people who are buying, who already have a number of properties and are wanting to buy a number. So pretty much the whole spectrum.
Great stuff, yeah. And the other thing I think you also do, if I'm right, is you talk to particularly the new investors about setting the loans up right so they're cross-securing their lending. Is that correct? Or do you want to speak about that in this environment? Or?
Yeah. It's probably one of the biggest mistakes, going back to that comment I made about boom times and recessions. And I would sit there and recommend for everyone that you set yourself up to be in the best position possible to be able to buy in the recessions. I wouldn't say I set myself up perfectly going into the recession last cycle, and I definitely missed out on some good deals from not having ourselves structured, perfectly. And while it's very hard to pick the tops and bottoms of cycles, and pretty much no one does it perfectly, I think you can still plan to be in the best position possible to be buying in those recessions, those counter-cyclical markets where property suddenly maybe falls out of favour, and those fantastic journalists about the Herald who own no property but like slandering about it. That's often the best time to be shopping. But part of the things everyone needs to do now is be in that position that they look favourable to lenders so they can still get money. So we tend to definitely recommend setting yourself up for the long run, and banks, I suppose, through this part of the cycle make it really easy to go, we're giving you money, put everything with us. But from experience, and if you talk to most long-term investors, they would repeat this, is that when you go through cycles, those same banks suddenly say, no, you've had enough, you're not getting any more. And if you get yourself too hooked into one bank, it becomes very hard to keep moving. So again, it's a case of I'll talk maybe a bit more about split banking later, but it's a case of getting set up so you can ideally continue to buy the whole way through a cycle.
Yeah, absolutely. I mean, you don't necessarily have to stop now, but getting that position to take advantage of the best time in the market when no one else is buying is crucial. And plan on being in the same position like you want to be yourself in the next time around.
Completely.
Yeah. I think probably the most important thing today to talk about will be the new LVR rules that came out about 3 weeks ago. And just on that, those who are listening who are all investing in the Auckland market, I hate to say it, but I've noticed a massive upward cycle going on in the last sort of 2 weeks, and we thought the Auckland market was going crazy 3 weeks ago. I think it's got worse, and it's as if people have realised now that it can only get 70% lending coming up soon, not 80%, and who knows what's going to happen in the next 2 months, but it seems to have gone crazy from the real estate side of things, from someone that's looking at deals every single day. So tell us about how you think it will affect the market, and what you think investors should be aware of with the new rules.
I'd completely agree with you in regards to the fact that it's made the market go crazy. It's like anything. If people are fundamentally interested in something and you give them a 6-month warning that in 6 months' time they might not be able to do something, well, that doesn't stop the market for 6 months. It just makes it go absolutely mental. There's naturally always people who procrastinate and do nothing, but for most people, it's made them go, okay, we should be doing something now. And I think there's a few key points just to probably quickly go over those LVR restrictions. Is that in the investor space, obviously from 1 October, it's going to be restricted that if you're buying a property, which is going to be an investment, you're going to have to put 30% deposit in. There was a commentary from the Reserve Bank when this initially came out that they wanted the banks to act within the spirit of the rules. However, the banks obviously are commercial and they're going to try and make as much money out of it as they can. What's hard to say is exactly when this rule change will come in. Obviously, we know that it has to be in by 1 October. The feedback I've been getting from the banks is that probably 4 to 6 weeks beforehand they'll bring it in to make sure they can be administering it properly from 1 October.
Okay.
And so it's a case of sitting there and trying to make as much kind of hay while the sun shines while you can. What we've been recommending very, very strongly to clients, going back to the split banking commentary I was talking about before, is probably post 1 October, if you've got an owner-occupied property and a rental property with the same bank, this will mean that the bank might sit there and go, okay, we can lend to 80 on the own home and 70 on the rental. And so you then need to have sufficient equity then to gear from that. What we've been saying is use this time now while you can to split the rental away to a separate bank, take that to 80%, take the additional top-up money back to the own home and pay that down, and then post 1 October you'll still be able to gear back to 80%.
So it's 80% against your...
Because you can still gear to 80%. So if you can get the rentals, or if you've got a number of rentals now to 80%, keep the own home away from it and put that equity back in there, then you're going to still be able to continue to take the owner-occupied property to 80% post 1 October. So it means you might be able to leverage more off the equity that you've got now if you do that than if you wait.
Okay. Yeah, no, that's cool. So just to make that really clear for investors, so if you can lend 80% against your own property still, and you're buying a property that's worth 500k in Auckland, you'll still got to get 400,000
on your own occupied property. But it's a case of often clients.
So you're saying yeah. So maximise up to that, so you have more available cash to get your 70% lending on your investments you're going to.
So often, because if clients have got, say, an own home and a rental property in the Auckland market with the considerable capital gains that we've had, over the last period of time, their rental properties might be geared less than 80%. So the issue is that if you try and gear up post 1 October, you're only going to be able to gear to 70 on the rental, and while you're going to be able to gear to 80 on the owner occupied, that's great. But if you take the rental property away now and gear up to 80, if that makes sense, you might be able to get that additional 10% restructured against the owner occupied, which you're still then going to be able to gear back to 80, which means that might get you into that next deal, which otherwise, depending on your equity levels, you may not be able to get into.
Yeah, makes sense. And if that confuses you a little bit and want to know some more information, and you've got a mathematician to go and visit, you can maybe email Chris or his team anyway, and to go through that. And just a reminder, that is only within the Auckland area, the 70% or new 70% LVR rule.
And I think that's a great point that Mark just raises there, is that it's going to, in my opinion, do two things. The investors who don't have the equity levels to continue to buy in the Auckland market but want to keep growing the portfolio are immediately going to look outside. And I've been talking to an investor earlier today who's looking in Hamilton, and they're just saying Hamilton's going crazy already. Tauranga is apparently starting to have quite a bit of activity. I've heard there that the market there is quite tight, and I'm sure this will spread around to maybe some other parts of the country, especially people who've been looking in Auckland who eventually later in the year find they can't get in but want to do something. You've obviously got lower price levels and higher LVRs. So I think that'll probably push some of the maybe Auckland-based money out into other parts of the country. On the other side of it, I noticed when the original LVR restrictions came in, the people who really benefited were the investors who were sitting on and then this was the ones around the minimum 20% deposit rules, or the restrictions around how much above 80% LVR lending could be done. The investors were the ones who benefited. The first home buyers kind of got stuffed, but the investors who were sitting on equity suddenly were able to have a bit of a field day. So if you're an investor who's got really strong equity levels potentially at that stage, kind of 1 October-ish, that's where maybe the Auckland market may become attractive for a period there, because a lot more people might get trapped out of the market for a period of time. So while we're in a very hot market now, you might find later this year there become some really good opportunities.
Yeah, I'm totally in agreement with that. I had a meeting this morning with a couple and spoke about 2 years ago when the first home buyer rules changed, and actually had a case of that which went along to an auction just after that it had been announced, and she was surprised she got a great deal. She was the only one there. All of a sudden, there were no first home buyers against her. So, yeah, we wave our crystal balls around, but we have got a bit of history from 2 years ago when something similar happened, and it might go through, and it might be the same thing in October, November for over the Christmas period. We might have a quiet part in the Auckland market, and if that's the case, there might be some good buys around, because there will be some investors or home buyers or home sellers, that have been thinking they're going to get this high price, and all of a sudden it might take them a wee while, some longer than others, to realise they're not going to get that price. So there might be a few good buys out there, and then probably normality will start sometime next year again. But and as I said, that certainly has the ability in other areas like the Hamiltons and Taurangas and other places around the country to benefit strongly from that.
And I think it's definitely a case of keeping an eye on it. And what I would fully expect to happen is around that, maybe a week or two before 1 October, and maybe the month afterwards, is to hear a few doomsday articles on some of the mainstream media, especially things like the Herald, in regards to the massive effect on house prices it's going to do, etc., etc.
The market's died.
Yeah, and you'll suddenly see people will have a freak out for a period. That's often one of the best times to be looking. So there's some great opportunities we're still seeing in the market now, but that then is definitely a time to target. Just when everyone else is maybe holding off for a couple of months, that's where there should be some really good buying opportunities.
Yeah, absolutely. With the other announcements that the government did, is anything that really you think is important from the banking perspective? I mean, the 2-year rule is not really a banking issue. It's more trying to pick up the people that are trying to do sneaky wee trades and not getting caught.
I mean, that one there I find interesting. My understanding, and I may not have this perfect, but I believe around the mid-70s there was a similar rule brought in where, quite similar, there was a tax to be paid if the properties were sold within a couple of year period. And I still sit there and go, people fundamentally look at ways to get around rules, so suddenly people will hold for long enough to get around the tax issue. I obviously, the majority of property traders who are doing things right, that doesn't change anything for. They're paying the tax already.
Yep.
There are maybe a few people who are sneaking like an occasional deal across the line, and I think a lot of that's going to be snapped up anyway because of the government's increase in the money thrown at the IRD to chase those people. So I don't think that's going to have much of an effect on the general market, really.
Yeah, and I think that's really only people who hurt, the ones who have had a sneaky one or two or so, and they've been trying to probably hide from the IRD and probably never would have got picked up. Where now they will, or they just have to declare it, I guess. So there'll probably be quite a few places sold in 2 years and a day, and coming up in a few years' time.
I think there's still the fact which will fuel especially the Auckland market is interest rates are, I think, lower than any commentator, say 12 months ago, would have thought they've been. And especially with the fact that the Reserve Bank's looking at ways to bring out tools to try and slow especially the Auckland housing market to allow them to reduce interest rates. It's a hard situation, that they're in. You've got Auckland in particular, and you've got the rest of the country, and the rest of the country definitely isn't going the way Auckland is, and that's it's not fair to keep, say, interest rates high just to try and control the Auckland housing market while punishing the rest of the country. And we've got this kind of weird perfect storm at the moment where you've got this kind of undersupply issue, very high migration coming into Auckland. And that's making some people in Auckland feel rosy, but I've got a lot of customers around the rest of the country, as I know Mark does, and it's definitely not completely the same around the rest of the country. At some stage, Auckland may go pop, and the rest of the country might be in a bit of a better position at that stage there. But at the moment, the Reserve Bank's obviously got to look at the whole country and try and do the best they can here. And I think they're trying to do that by bringing in this rule. They've gone back on what they said a couple of years ago, where they wouldn't try and target one demographic area, but they're probably trying to do their best they can. They can't tighten things up too much, because if they end up in a situation where they turn the supply tap off in Auckland, all we're going to end up with is probably a bigger boom down the track. So they need to allow supply to kind of come on at a really, really good rate, while hoping things, I suppose, don't go too far, you know.
Yeah, no, that makes sense. It's a damn hard job for the Reserve Bank to decide on that, and as you said, there's the rest of the country to think of. It's sorry to say, Auckland, it's not just Auckland and New Zealand, and
yeah, agreed.
And it's good. It's great for investors at the moment in Auckland, because the interest rates are probably going to stay low, and you're saying, Chris is just saying then, it's lower than a lot of experts have predicted. It's probably been like that now for about 2.5 years. Everyone's sort of going, oh, they're going to go up a little bit, and then they go up for a 0.25 or 5, and then they come back again.
There was definitely the stage, I think, around early last year where, from a prudency point of view, we were trying to say to clients, and many other people were as well, you need to make sure that you're budgeting your overall interest rates to be maybe, say, around that 7% point of view from a worst case scenario if they continue to rise. And a lot of our interest rates, of course, aren't affected by just what's going on in New Zealand, by overseas, and so certain countries have ended up in worse situations than what was expected, which is why our interest rates are a lot lower. So I think there was a period last year where a lot of investors have been kind of maybe working off, say, 7s, and now we're seeing them back down around 5s. That suddenly meant that people are going, well, the cash flow's a lot better, we can pay more, and that's had quite a bit of stimulus to especially, say, the Auckland market in the first few months of this year. I still think people need to be a little bit careful on that. I think the interest rates still potentially could trend down a little bit, but it's just a case of understanding that they could bounce back at some stage as well. So you're not wanting to be too aggressive and take on too much debt. There needs to be a little bit of a buffer on there if they do bounce back at some stage.
Yeah, no, definitely. Just speaking of the banks, I mean, the probably most common thing going on there at the moment is the new LVR rules. Are there any other stuff the banks are talking about at the moment with regards to property you can think of, or is it mainly all LVR rules?
The banks, I suppose, are a little bit of a mess is probably the wrong word, but it's quite, to be fair to the banks, a complicated situation at the moment, where you've got the Reserve Bank bringing in quite a few changes, and when you're dealing with big organisations like them, to be able to monitor that, you need some pretty impressive infrastructure behind the scenes. And they are businesses, so the majority of their IT is dedicated towards actually growing their businesses, not necessarily just changing regulations which are coming in. And so something like those LVR rules, when it got thrown in, I was at it was actually a BNZ session that I was with us starting to work with them later on that day, and they're like, we've got to get onto this within a reasonably short time period. We've got rule changes in regards to other investment changes. There's things to do with whether the banks are being made to hold more capital in regards to investment loans, and so they're getting made to try and monitor a lot of changes all at once, and you can't implement those changes into a system immediately when you're dealing with organisations the size of the banks. So at the moment they're at, I suppose, a point in the cycle where they're trying to be, you've got a complete bank war going on. I think most people have heard about the interest rate, battle and the amount of cash contributions and that are being thrown on, and some of the deals that are being done. So they're all very, very competitive, and especially with parts of the market being made harder to fund. So like the original LVR rules, where they were doing probably, say, 20-25% of their funding in that above 80% space, that's been cut back. They're trying to maximise the other areas at the moment, and so they are fundamentally businesses trying to make as much money as possible, but they're now getting made to do a lot of these infrastructure changes. So that's definitely made it a bit challenging for them. Where I think things will be interesting is that they'll probably start to maybe look at relaxing other parts of the policy. So things like new builds are obviously exempt from the LVR rules. There's been murmurs, and I think I saw one article the other day about maybe banks relaxing some of the criteria around apartments. And so this is where it's definitely worth keeping an eye on the apartment market. If you relax restrictions around finance, that tends to have a positive impact on maybe capital growth in a sector. Obviously, there's other factors you've got to look at, but if more people can get finance, increased demand can have a potential positive impact on prices. And I think with especially a lot of the stock coming on, say particularly in places like Auckland and Christchurch, if people can get them with lower deposits, that might mean there's some growth in some parts of those sectors as well. So I think I will see a few changes there. I think with there being so much change around regulation, I wouldn't say we've seen as much. We've seen a lot of change on in regards to building criteria in the last 12 months. Banks used to be, as a whole, very conservative in the build market, and they've relaxed hugely there. So there's things like maybe opportunities in regards to new stock, and with the LVR restrictions, I think if there's investors who are maybe cash flow rich, but maybe equities are a restriction, then maybe looking at maybe some new build opportunities is a good option.
Yeah, and I see some people looking at that because of what the bank are talking about coming up, and
Yep.
what have you. I think what the bank have done well this time and helped control the market was, I probably learnt last time around, they lost a lot of money, I guess, but they just gave money away, 2007 and 8,
Yep.
so freely, 115% loans and 100% loans, and as I said, you can no doc loans and with other people, organisations, and that helped get a lot of people in a whole lot of strife, I guess. So I suppose what's happened this time has been a bit more of a controlled market, even though people in Auckland who are trying to bid at auctions might not think that right now. But it certainly has, and it's probably been, and it's been good. It's been good for the market not to let it go totally out of hand, I guess. So just obviously you've got an expert in banking and finance here at the moment, and there might be some new investors who are about to embark on getting their first home or their first investment property. And one thing I don't need Chris to say, but I'll tell you for him, is you need to get your finance sorted before you go looking at the first investment. It puts you in a stronger situation to negotiate well if you know you've got your finance all sorted, which is great. But for you're out there, well, what makes your life easier when you get someone coming to see you for an appointment when they want money? How can they help themselves?
I think it's, if I can maybe slightly rephrase it, it's a case of we see a huge amount of people who, what happens is they might have bought their first property, wanted to charge into the market, and they've gone and bought something, and then they have to get it fixed up. And what I mean by that, it's been structured wrong in regards to maybe what they're wanting to do long term. They haven't maybe sat down with someone to kind of go, this is where we're at, this is where we want to go, and you maybe got the correct advice around things like structuring, and that's what I'm meaning there is things like entities. There's also what I was referring to before with split banking. We are a strong proponent of keeping your family home, if you have one, away from the investment lending. So we sit there from a long-term point of view going, ideally try and have your own home with one bank that you don't have investment lending with. Try and store as much of your equity there over time by continuing to top the rentals up with other lenders right back at the own home, and ideally have a revolving credit facility in place, which is your money for, say, deposits and also working capital if you're going to do renovations. And then it's a case of also, if you're in the market at all to buy, try and look to get pre-approval, say, in place. For the majority of people, to have a level of comfort, you want to have the pre-approval sitting there. I see a lot of clients miss out on deals, and this is a speech I give, it feels like about 20 times a week. And what always happens is a lot of those people come back when they've got to deal with 2 days, and you'll see this, Mark, with 2 days due diligence. And in the current banking environment where they're all under the pump, it doesn't matter how fast, say, I am, the banks can be quite slow. And I think to make sure you're doing the right thing for yourself as an investor, you also don't want to be thinking about the finance or what entity I should put this in. You just need to be thinking about, is this the right deal for me?
Absolutely.
So it's a case of sitting there and go, make sure you're ready. And that's a case of, while you might be out there wanting to buy a deal in the next week, you're better to sit there and spend a few weeks to sit there and go, okay, why am I getting into property? this is where I'm at. Where do I want to go and maybe kind of get some buying rules? Because I see a lot of people still, I'm sure you do, Mark, who they know they want to and they feel they need to buy property, but they don't really have any idea of what they should be buying. So we see a lot of people who they go charging into something going, oh, this looks good, and they back out 2 days later because they don't really know if that applies to them.
Yeah, absolutely. I've had that conversation 20 times a week with to tell me why you want to do property and what your goals are, what you're trying to achieve out of it. If you don't really know what you're trying to achieve out of it, you're just going to wander along and buy some stuff that may be good, may not be good.
Yeah.
And you need to have a focus on what you want to do. And in the Auckland market, especially, as Chris just alluded to, you have to be prepared. If some people are buying properties unconditional within a day have been on the market, so you can't compete with them. You can't compete with a guy that wants 2 days DD or even 5 days DD. And those that I talk to that have got it subject to finance, they go and get their finance. And as Chris has said, you think of any business you're in at the moment, multiply that by 100, and that's probably where the banking industry at the moment is, with loans coming through from all various ways and factors. So it's not their fault they're flat out, it's just the way the market is. So by being prepared, you can certainly go out there and negotiate a better price. Shorter due diligence you can put, the better price you can get. And at the end of the day, you make money when you buy property.
The clients I see do the best, and I'm not recommending anyone do this. This is people who do enough activity, they've got to a stage where they're confident enough to do this, are the ones who literally can just go straight unconditional on deals. And so these are people who do a lot of transactions, and they've got to a stage they understand behind the scenes. It's they'll get the finance, they understand enough about the structuring, and they can just look at a deal and make a really quick decision on the spot. So I'll repeat that again: don't do that. That's not for most people. But what it enables them to do is get deals maybe more quickly than or maybe better deals than most people can do. Now, while most people shouldn't do that, you can still put yourself as close as possible to do that by being ready, and that's having the buying rules, understanding what your properties are going to go into, having your finance basically ready. So and having a quick ability to do quick numbers. There's enough calculators or most people should be able to do that on a basic spreadsheet these days, so you can quickly look at a deal and go, does this meet my rules? If it does, then it's a case of going, well, okay, what due diligence do I have to do to make sure this is the right deal for me? Tick, 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 and you can move. And it's the people who can sit there and really quickly move who tend to be successful while being able to quickly tick boxes off.
Yeah, absolutely. And a few of our clients are like that. I had one this morning. We had a place in South Auckland. Went through the property. She knows exactly what it costs to do things. She knows how to work the council. She knows what it is for renovation, and says, "Yeah, I'll put an offer. I know what I'm going to put in, and this will be X dollars, and she'll get the deal." So by being prepared and knowing that, but that's an experience thing, and does take quite a long time, obviously, to get to that stage. The first home or time investor might sit there and they'll sweat about it, or they haven't got their plan sorted, and they're thinking about it, it's been sold, and they'll be back up offer. But that's just an experience thing, and yeah.
I would sit there and say I think it's a case of, while I'm going to emphasise having buying rules, it's a case of having a realistic buying rules as well. And something I've noticed a lot with property investors, especially in the last 6 to 12 months. Again, mainly I'll hammer the Auckland market here, but with prices going through the roof and that's meant in general yields have dropped, as you've still got some people who are working off these buying rules which are completely unrealistic and out of the market. And so what happens is that they tend to run around looking for these very high returns, which for most people don't exist, to be completely blunt.
Yeah.
And so what happens is that they miss out of the market for 6 months, and we've seen some people then that they've finally got emotional and they've gone and bought something which they probably shouldn't have bought because they've spent too long and they feel like they have to get in the market. Try and understand the market, have your buying rules, it has to work for you, but we're not sitting here with having these very high yields in reasonable suburbs this far into a cycle. So you need to make sure your yields are realistic, or if you can't realistically find that property, say in a market like Auckland, it may be better to go out of Auckland and then look at other options.
Yeah, and there's if you read a book on property investing, you start at chapter 1, then you put that into practice in today's market, it's not going to work. So we're probably at chapter 17 or something. And as I said, the inner suburbs like Auckland have gone, and you're you've got to see where the market is. And in Auckland in particular, right now, this year's been a classic example. In 2 weeks, a lot can happen. And I think in a 3-month period this year, every house in Auckland went up $30,000 or $40,000. That's just what happened. So as Chris said, those ones that are coming in thinking, they want to, whatever the percentage of the yield might be, is 7%, 6.5%, whatever, is they look at it and they come 2 months later and go, right, I'm ready to buy, but the market's moved on again in that time, so they're always behind the wayside. And so, just a one wee tip is, as Chris said, some people then go and buy something. And I've had one bad purchase in my time, and that was through impatience. So one of my top 3 or 4 tips is don't buy, or not impatience, the desperation of actually buying a property is the wrong reason to buy a property. You can buy quick, but it's just, it's got to be the right property. You've got to be ready to buy. Don't wait for 6 months because you've missed out on the market and then buy.
And especially for people who want to use property as I suppose, a real long-term wealth creation vehicle to take them maybe from where they're at to where they maybe want to be at retirement or financial freedom or whatever you want to call it. I always sit there and go, you want to have your buying rules. What we try and do with clients is sit there and we try and spend time with people to go, okay, you need to understand your buying rules, but you also need to understand how you look to the banks. Because I see a lot of investors who they go running out there, they buy a couple of properties because it may work, but their overall financial position doesn't allow them to buy anymore. So you're better to understand maybe earlier on in the process what your strengths and your weaknesses are. I'm not saying that you should then change your buying rules for it, but you're better to understand maybe, say, 2 deals away from hitting a brick wall. Maybe that, say, equity is going to be a reason why, which is going to hold you back, or especially servicing. We find with a lot of clients, they understand LVR and equity because there's been so much talk about it. But around the servicing side, there's a very big difference to the way investors run their numbers and the banks run their numbers. So it's a case of I sat down, I've seen a lot of clients who they look at their numbers and go, but we're cash flow positive theoretically, but because of the way the lenders calculate the numbers, they might not be able to borrow anymore. Now, if they'd managed to understand this 1 or 2 deals back, there was things they could have done that they could still be in the market buying now.
Yeah, just on that, it seems to change every 5 or 10 years or so. What's the how much of the rental do banks, as a general rule, how much do they count towards the servicing?
The majority of the banks take 75%, and I'd say a lot of investors understand that side. The part which has definitely changed a lot over probably the last 12 to maybe 18 months is the way that the banks look at the mortgage debt. So the majority of the banks, what they're doing is they're not looking at what you're paying on a mortgage. They're taking the total, mortgage debt, and they're whether you've got an interest only or principal and interest, they're always qualifying on a principal and interest basis, and they tend to use much higher qualifying rates. So while we might be sitting here at the moment and we're seeing interest rates in some cases back in the 4s, you got some of the banks using, they're gonna, while they might give you that money, say with a 4.99 at the moment, they are going to qualify you on an interest rate not far off 8%. So when you start taking, say, $1 million of debt at, say, an interest rate of 5% on an interest-only basis, that might be, say, $50,000 over a year you're paying. But if you put that $1 million through the calculator that the bank's going to use to assess whether you can get more borrowing, and they're going to assess you on an interest rate close to 8 on a principal and interest basis, that might be $95,000. So you're paying 50, but their calculator to assess whether you can get more money says 95. On top of that, when they slice 25% of the rent out, you can go from a cash flow, actual positive position to a very negative position. And so this is what's tended to happen to a lot of investors. Now, this is where the structuring of the mortgages is important, because if you want to keep buying, there's lenders which are harder in this area and there's lenders which are more relaxed. So what we try and do is we understand where a client's at, where they're wanting to go, and in some ways it's a case of you don't want to keep running back to the bank who's too tight, because eventually they go, no, you're completely tied up and it becomes expensive to move. You need to be in a position that you understand you're not going to maybe be able to do more with them and then move on to a more relaxed lender earlier on in the piece.
Great tips here in the last few minutes there. Chris, so if people want to get hold of you, how do they do it? Obviously, listeners from all around New Zealand and some overseas that listening in, so how do they contact you?
Probably best to email myself at Chris at Chris Pedersen, which is KRIS at KRISPEDERSEN.co.nz. Or you can jump on our website at www.chrispedersen.co.nz. And yeah, just feel free to get in touch. One of my people can then kind of be in touch, find out the best way we can be of assistance, and we can look to help you from there.
Well, thanks, Chris. It's been really beneficial for everyone listening, I'm sure. They know how to get a hold of you, plus we'll have your name on the website anyway. So, yeah, thanks for your time today, and we might get you back in some other time to have a chat about another topic maybe.
Thanks, Mark. Thank you, and thanks to all the listeners for your time.
It was great having Chris with us today, and hopefully you all learned quite a bit from him, what's happening with the banks at the moment, and how you can help yourself with working with brokers or other financial institutions. Remember, if you enjoy these podcasts and there's someone that you wouldn't mind listening to, drop us a line at Property Ventures, and we will see if we can organise it for you. In the meantime, have a great week, and we'll be back next week.